Hello, I'm Michael Greenberger. It's good to follow Frank because I believe that the parallels between the 1920 and 1930 New Deal are very apt when we talk about over-the-counter derivatives products or swaps. As a result of the Great Depression and the instability of the equity markets, the Securities Act of 33 and 34, how appropriate to talk about them at the Roosevelt Institute, which were driven by Franklin Delano Roosevelt, not by Congress, established a template for regulating financial markets to prevent them from falling into systemic risk. And the template was transparency, record keeping, open exchanges, capital adequacy, regulation of intermediaries, self-regulation of the exchanges supervised by the federal government, private rights of action by individuals, anti-fraud, anti-manipulation, keeping states with the power to deal with their own challenges to fraudulent and manipulative equity products. It is little known that soon after the Securities Acts of 33 and 34, Franklin Delano Roosevelt once again pushed through the Commodity Exchange Act of 1936, which was a statute to regulate the hedging of agricultural products. Once again, open, honest exchanges, regulation of intermediaries, public transparency, capital adequacy, anti-fraud, anti-manipulation, private enforcement, states being able to sue on behalf of their citizens. The futures markets expanded from agricultural products to energies and metals, and soon everything became commoditized. In the late 1980s, the so-called over-the-counter derivative or swaps market was created. The swaps market is nothing more than a futures market. If it is a futures market, it should have followed the Commodity Exchange Act of 1936, which is to say all swaps, futures, should have been traded on open, public, transparent exchanges, marked to market, cleared for capital adequacy, regulation of intermediaries, anti-fraud, anti-manipulation, private enforcement, state enforcement, but no, that didn't happen. Simply because the banks said swaps are not futures. Now, we went through cycles of instability, the bankruptcy of Orange County because of gambling through swaps, the fraud of Bankers Trust against its customers, Procter & Gamble and Gibson greeting cards, with tapes of salespersons laughing up their sleeves at how they'd taken their customers to the cleaners. The failure of long-term capital management, trading swaps. In 1998, Brooksley Born, who's in the audience today, said the brutal truth: swaps are futures, and they must, as is true of all regulated markets, be traded according to the normal templates of regulation: transparency, mark to market, public exchanges, adequate clearing, regulation of intermediaries, private enforcement, anti-fraud, anti-manipulation, state enforcement of actions. And despite what was blood in the streets as a result of the near failure of long-term capital management, Congress on December 15th added a 262-page rider to an 11,000-page appropriation bill. It was brought to the Senate for the first time on that lame duck session. It passed 95-0, 4 votes in the House of Representatives against, supported by Larry Summers as Secretary of the Treasury, Alan Greenspan as chairman of the Federal Reserve, Arthur Levitt as chair of the SEC. Deregulate these instruments. No public exchanges, no public transparency, no anti-fraud, no anti-manipulation, no state causes of action. Private rights of action to enforce what? There are no obligations. The smallest broker in the smallest town in the United States of America must take a competency exam, must be registered, owes a duty to his customer, a fiduciary duty if he's trading for the customer, and an agreement not to act recklessly if the customer is directing his account. In the swaps market, as Frank said, a $600 trillion notional value market, there is no competency exam for swaps dealers. The only guarantee is that AIG hired the swap dealer to issue credit default swaps to guarantee collateralized debt obligations. And not only credit default swaps, but naked credit default swaps, where you just take a bet that something is going to fail. Bet that people won't pay their mortgages. For every credit default swap that insured a CDO, there were 3 credit default swaps that were naked, just naked bets that there would be failure. And when the American taxpayer rescued AIG to the tune of $180 billion, that money went right through AIG to Morgan Stanley, Credit Suisse, and 13 other banks. Were those naked credit default swaps? We don't know. Now, Congress is moving to, quote, reform this market, with the exception that if there's a currency swap, it won't be regulated. Heard about currency swaps lately? Heard about Southern Europe? Heard about Greece? Non-transparent, no capital adequacy. Yesterday's Financial Times has an article that says, we don't know who holds credit default swaps on Greece. We don't know who holds naked credit default swaps on Greece. Therefore, we cannot regulate. It is just the opposite. We must return to the Rooseveltian New Deal of transparency, capital adequacy, anti-fraud, anti-manipulation, private enforcement, state regulation. And we cannot be where we are today, where the movers for reform, Americans for Financial Reform, Heather Booth is sitting in the audience, are fighting the Obama administration as much as they are fighting Wall Street to gain this kind of transparency. The Obama administration has supported exchanges that don't really trade. They've supported preempting insurance laws to apply to credit default swaps that are nothing more than insurance. They've supported laws that say if a swap doesn't satisfy the law under which it is originated, it cannot be voided, nor can damages be awarded on it. It supports barring gambling laws. What are naked credit default swaps? What are people doing with Greece right now but gambling that Greece will fail? State gaming laws are preempted. Anti-bucket shaws are preempted. And Franklin Delano Roosevelt must be rolling over in his grave.